Hey everyone, so this week we got two new videos from Ray Dalio, one that he posted himself on his YouTube channel, and another that just came out from CNBC International. And I can almost guarantee that you haven't seen at least the second video because it currently has less than 200 views. Oh, and speaking of views, I just want to give a huge thank you to everyone who watched and engaged in my latest YouTube video, which was on Michael Burry's stock market predictions. It currently has over 100,000 views in just a few days, and that is only possible if you guys are watching, liking the videos, and engaging in the comment section. So a big thank you to everyone who does that on my videos week after week. But with that said, let's jump into today's video. In the first video that Ray Dalio posted this week, he gave his opinion on whether stocks are in a bubble.
I was asked to talk about bubbles. You know, is the market in a bubble, stock market in a bubble, what's in a bubble?
And it seems like he's following in the footsteps of many other investors recently who have been sharing their opinions about whether the stock market is overvalued, whether there's pockets of the markets or financial markets that are overvalued. And most notably, out of all of that, we had Michael Burry, which I spoke about last week, and his Twitter storm that went for about a week before he again deleted his Twitter account, where he basically said that he thinks the mother of all crashes is coming, which is a very, very dire prediction. Dalio's approach to analyzing whether there is a bubble in the stock market is to use 6 measures of what he calls unsustainable stock prices.
I basically thought there were 6 things that made a bubble in my mind, and I'm going to rattle them off, then I'll apply them so that you know what I think.
And these measures are prices compared to traditional methods, prices are discounting unsustainable conditions, new buyers have entered the market, broad bullish sentiment, purchases are being financed by high leverage, and finally, buyers or businesses have made extended forward purchases. The point with these measures is not that this is a checkbox system that every single bubble box needs to be ticked in order for there to be a bubble, but the point is that the more of these characteristics or measures in the markets that become overheated, the more likely we're going to see a bubble and a significant collapse in stock prices. For example, in the dot-com bubble, every single one of the measures was screaming a bubble in internet companies specifically, not the broader market, but just companies related to the internet. But as you can see, in 2007, only 2 measures were showing a bubble, and the market still collapsed over 50%. When Dalio looks at the broad markets today, he actually doesn't see any of these measures showing that we are in a bubble, but there are 2 measures which he sees are in frothy territory, which basically means they're the step before he would classify them as a bubble.
Number 3, so one of those measures of the speculative elements is new buyers in the market. They're attracted in the market. You know, it's the sort of thing where, you know, you go to a cocktail party and people who are never involved in the thing are investing in it. And that could be tech stocks and it could be real estate and whatever, but, you know, they're drawn in, and that there's big bullish sentiment. So everybody wants, not having these things makes you feel dumb.
One of the biggest concerns right now for stocks is the huge amount of inexperienced and new investors that have entered the markets in the past few years, particularly with the rise of things like Robinhood, these brokerage-free trading apps, and being able to buy fractional shares so you can invest in companies with very, very small amounts of money. You have a huge number of inexperienced investors flooding into the market. And while using the word concern in relation to new retail investors might sound like something a salty hedge fund manager would say, the truth of the matter is that as new investors come into the market, it brings more irrational stock market behavior into the financial markets, because people who are new to the markets are far more likely to speculate on stocks they don't understand, as well as just want to participate in the gambling side of the stock market with small businesses or high growth companies. And on top of that, there definitely is a significantly broad bullish sentiment in the markets, right? We did have a collapse last year, but what happened last year basically told new investors, well, it told everyone, but particularly new investors who are inexperienced, that it doesn't matter what price you pay for a stock, because even though the markets went down 30-35% broadly during just a few week period, stock prices went back up and not only met levels before pre-pandemic, but actually went significantly above that in less than a year, which basically indicates to new investors who don't understand that that is not normal, that you can pay whatever price you want. It doesn't matter if you overpay for a stock, and even if there is a crash, in 12 months' time, you should expect to be back to where you were previously. But more often than not, when there is trouble in the stock market, it's usually concentrated in certain pockets of the market. So what Dalio did beyond just looking broadly at the stock market was he applied these 6 measures to every single individual stock in the US stock market, and then looked for patterns to see if there was any areas that looked particularly bad, because of course, at any point in time, there are some businesses that are in a bubble and others that are not. And what he found was that overwhelmingly in the emerging technology section, that these measures were lighting up for a bubble.
I apply that framework to all individual securities. And I do that in a systematic way because my process is to write down the criteria, to use filters and so on, and try to see which are in a bubble. So there are different stocks. Some are in bubbles, it seems to me. Some are not in bubbles. And the stock market as a whole is indicated by that table. Let me just go to the next chart. So this chart goes back to 1910, and it shows on an indicator the degree to which we're in a bubble. You could see that it's bubbly, and it's not as high as the total bubble, but not as high as it was in 2000, not as high as it was in 1929, but higher than it was in 2007. Let's take a look at the stocks that are in a bubble. A lot of stocks are not in a bubble according to those criteria. So this goes back to 1995, that chart, and it gives you an idea. So the first chart is the share of the top 1,000 charts that are in a bubble. And so it's been about 5%, or the share of the S&P 500 about 2% by comparison to those in 2000. Again, not as high as the 2000 bubble or the 29 bubble, which were comparable, but higher than 2007.
So what Dalio is seeing right now is that there's actually less stocks that are in a bubble than there were in 1929 before the Great Depression, and also in the dot-com internet bubble, but actually more than there was during the global financial crisis in 2007, 2008. And that actually makes perfect sense, because in during the Great Depression, or leading up to the Great Depression, and in the dot-com bubble, the stock market themselves were seeing huge increases in prices, whereas in 2007, what you actually had was the housing market collapsing, and then the effects of that flowing into the stock market, rather than the problem actually beginning in the stock market. At the end of this video, Dalio again gives a summary about why we're seeing this kind of bubble activity, and why it is completely normal and has happened many, many times in the past.
So why are we in a bubble? This chart goes back to 1900, and the top chart shows debt to GDP. The bottom chart in the blue line shows interest rates, and the red line shows the printing of money, the amount of money that's going in. And so what you can see is when you have a lot of debt, like we have a lot of debt now, and there's a lot of increasing debt, and there's the hitting of zero interest rates in both cases. There's the printing of a lot of money, and that's a key element of the bubbles, because they have a lot of liquidity that comes into the market, and then there's a lot of throwing around that money in terms of bidding up all sorts of assets. So you could see that red line. You could see how when the blue line hits zero, the interest rates 1930, starting in 2008, and since we've had that movement, then you see the largest movement now. So a lot of liquidity, a lot of debt financed debt monetization makes for a classic bubble.
As I've spoken about in a lot of videos recently, if you look at any of my Ray Dalio videos, this has come up in some way. All of this impact in the markets, overvalued businesses, pockets of the market in bubbles, new investors entering the market at significant rates. All of this is the result of 0% interest rates and a massive increase in the money supply, and that is driving up asset prices across the board. in any kind of asset class, really. And it's something that is frothy now and may get worse, and it certainly won't last forever. The second clip that I have for you today is just a short clip where Ray Dalio was on CNBC, and he actually spoke about the effect of SPACs, special purpose acquisition companies, and what he thinks about them generally as investment opportunities for retail investors.
Generally, what's put into the structure, it's not as well regulated because there are more liberal rules as to what the SPAC can buy relative to what an IPO is. So, and a lot of the companies are, let's call them new idea companies that haven't reached the same level of due diligence and disclosures and everything that's required in terms of the IPO market. What I'm saying is that as a investment vehicle, it's more prone to a bubble mentality, and it's prone not because of the absolute structure of the thing, but because of what it allows and how it is operating within that.
Unsurprisingly, Ray Dalio is not the biggest fan of special purpose acquisition companies because basically it means you're investing in a company that does nothing, may never do anything in the future, and you're investing eventually into a company, in most cases, that is going to be at a huge valuation, and you're going to pay huge fees on it. So it really is just the latest kind of new thing that institutional investors can sell to retail investors when the other things that they were selling to retail investors previously are no longer fashionable. Typically what happens is after a recession, slowly over time, the number of IPOs starts to ramp up and institutional investors can push these new IPOs of smaller and more speculative companies to retail investors. But eventually, if retail investors are not making money on things like IPOs, then institutional investors try and get creative in order to create some new thing, some exciting thing that may be able to attract those retail investors. And at the moment, that thing is SPACs, which is almost the exact same as investing in an IPO, except you don't even know what company you're investing in. So it's even worse than that. And again, this is all not surprising. This is all late stage of the cycle or of the long-term cycle behavior where you have a huge amount of money flowing around in the markets and institutional investors are taking advantage of it with all of these new investors coming into the markets and selling new products and new vehicles, investment vehicles and things, new index funds, all of these different products that they're trying to sell because there's so much money going around in the markets right now. And honestly, it's a frenzy that a lot of big investors, a lot of big value investors have been talking about for the past few years now. So it seems like, it starts to sound like a broken record when it's been going on for a few years, but we never know when these things are going to pop. We can only look at the conditions and say that these are unsustainable conditions. Maybe these unsustainable conditions go on for another 5 years or another 10 years. Nobody knows what's going to happen, but it is important to understand how these things function and what we should expect in the future. And what we should certainly not expect in the future is that markets will just continue to go up in a straight line for the next 10 to 20 years. But that's all for today's video. I hope you guys got some value out of it. And as I said at the beginning of the video, I would very much appreciate it. Take the 2 seconds to leave a like on the video. And if you want, leave a comment down below. I'll be answering comments and questions down there as this video goes live. But with that said, hope you guys have a great day and I'll see you in the next video.